And then I would like to think about the best way of concluding this evening, because we have had a discussion all day that involved policymakers, central bankers and academics, and it seems to me that only somebody who is both a very, very distinguished policymaker and a very, very distinguished academic can finish this evening off in the way that it should be finished off. So I would like to ask Lord King of Lothbury, Mervyn King, the former governor of the Bank of England, to give some concluding thoughts on which we could rest until Sunday evening. Thank you.
Well, ladies and gentlemen, good evening. And on your behalf, I want to thank Jens Weidmann and his colleagues for putting on what has been an extraordinarily fascinating conference with not only a star-studded panel, but actually panelists throughout the day who were beautifully selected for the topics that we wanted to discuss. It's been a quite fascinating experience. And sporting metaphors often come in help. And after a great sporting event, when you've seen brilliant individual performances, the highs and lows, at the end of it, the audience is normally exhausted. And the last thing they want to do is to hear a commentator tell them for 15 minutes what they've just seen. So let me try to be brief and pull out a few themes or highlights from what we've heard today. As Charles Goodhart reminded us this morning, the basic theme of the conference, which is how crises have changed the theory and practice of central banking, is an old one. And these debates go back not just to Bagehot and Thornton, but to other practitioners who debated with them. And I think it is sensible, and I think that many of the points brought out today help us to think about what central banks are for and why we have them at all. The first panel set the study of central banking into its proper historical context, and I think that was extremely helpful. And the second led on from the issues discussed in the first panel about the nature of central banks and the limits to what central banks should do. And I think 3 points came out from this very clearly, which I don't think are well understood in much of the commentary that one sees in both academic work or indeed popular writing. The first one that was stressed by a number of people, certainly Charles Goodhart and Ben Friedman, was that it's not sensible to think about a trade-off between price stability and financial stability. I think in the wake of the crisis, a lot of people reacted in a rather simple-minded way by saying, before the crisis, because central banks were targeting inflation, therefore, it was a mistake to worry about price stability, and there is a trade-off between price and financial stability, and monetary policy should be used to meet some combination of the two. And I think in practice what came out from the discussion very clearly was that actually these are two separate objectives. They are certainly related, both of them, to the ability of the central bank to create and provide money, but they are two separate objectives. Both are important. The second point that came out very strongly, and this is one that both Ben Friedman and Marvin Goodfriend stressed, was that the lender of last resort is a fiscal action. And I think this is absolutely fundamental, and I'll come back to the application of this in the euro area later on. If the central bank is going to be a lender of last resort, and there's no doubt that in terms of the mechanics of providing liquidity and perhaps assessing the quality of collateral, making the lender of last resort role function properly in practice, the central bank is going to be involved. But the question is it sensible for the central bank to take upon itself, without proper delegation from Parliament or Congress or the executive, decisions about potential losses to taxpayers? During the crisis and afterwards, the Bank of England put in place a very explicit framework, which was that any lender of last resort operation had to be approved by the Chancellor of the Exchequer. And that it was formalized in a memorandum of understanding which I and the Chancellor signed. Some people thought this was narrowing the range of responsibility of a central bank and giving up powers which a central bank should keep to itself. I was of the opposite view. I don't think it was sensible for a central bank to take upon itself this responsibility without ensuring that the executive and the legislature had effectively committed to the framework in advance under which these actions were taken. Now, during the crisis, perhaps I shouldn't have been surprised that actually politicians didn't want such a framework. They wanted to put pressure on a central bank to act as a lender of last resort, but they didn't want to be seen as taking any part whatsoever of responsibility for the actions involved in case there were losses down the road. It was only after the crisis that it was possible to formalize this in an MOU. And I think more generally, and I think Charles Goodhart referred to this just now, there is an inherent danger in a central bank behaving in the way that most academic economists do, which is, here is something that's good for the world, let's do it. It's not the responsibility of the central bank to do everything that the world needs. And I think for that reason, and this was the third point I think that came out, central banks ought to be cautious about leaping into roles such as market makers of last resort or extending powers too far. And whatever powers it should be exercising, they need to be done with a proper remit given in advance from the legislature. I think during the crisis, one can argue that some central banks sailed a little bit close to the wind. And you've seen, I think, in the United States that the reaction in Congress has been entirely predictable. And it's led to the Federal Reserve now becoming exposed to a never-ending and rather exhaustive set of proposals from Congress about its role, trying to limit what it can do in the future, which is going to potentially damage what happens in the future and distracting the Fed from its role today. Mario Draghi in Europe has gone out of his way to say publicly and repeatedly that the European Central Bank cannot substitute for governments if they fail to provide a proper infrastructure to make transfers, create a fiscal union, and to do what is needed to support a monetary union. Its actions in launching this year a program of sovereign bond purchases were actually a rather conventional example of traditional monetary policy. But its intention in 2012 of launching outright monetary transactions is, I think, rather hard to square with a central bank role where governments are still maintaining, as we heard today, the view that there should not be transfers between the member states in a monetary union. And I think it will be very interesting to see how the Federal Constitutional Court in Germany responds to some of the rather dubious and unconvincing arguments put forward by the European Court of Justice earlier this year. Now, we had a fascinating conversation between Michel Sapin and Wolfgang Schäuble, as ever elegant and masterful in their ability to sidestep the difficult political and economic questions surrounding the future of monetary union. I thought it was a wonderful demonstration of why politicians are different from central bankers. Politicians are people who know that every cloud has a silver lining, and central bankers are people who know that for every silver lining, there is a cloud attached to it. Now, I don't want to intrude on private grief, but when a marriage goes wrong, it's disturbing to everyone. When two people start shouting at each other, it keeps everyone awake at night. And I was present at the wedding in Frankfurt. When the ECB was set up, there was a lovely ceremony in the Alte Oper, and we all came back again for the 10th wedding anniversary, also in the Alte Oper. But now the marriage has hit a rocky patch. Now, I'm not a marriage guidance counselor, but I thought the basic principle was that in a situation like that, it was sensible to face up to the problems and try and be honest about them and then see what is the right solution. not sort of talk about how jolly the wedding was and how marvelous Francois Mitterrand and Helmut Schmidt were at the wedding. They're not here now trying to deal with the problems. And I was struck by the contradictions. Michel Sapin talked about the importance of transferring competences, and then in the next sentence pointed out that the constitution in France gives their parliament the right to set the budget. These two are incompatible, and something is going to have to give, and it may do over a long period of time, but it certainly isn't going to happen quickly. Wolfgang Schäuble seemed to accept the IMF's view that Greek debt was unsustainable, but then said there could be no transfers among member countries. I think the only plea I would make here is that it is very important, above all else, that what happens in the discussions and negotiations does not end up in a situation where monetary union is becoming the enemy of democracy. And I think the European Commission has come very, very close to making that something that is easy to believe. Let me comment on Paul de Grauwe's points before going back to some earlier issues. Paul talked about the ERM in 1992-3 and the fact that the Bundesbank in that system should have been prepared to supply infinite amounts of liquidity. Well, we would have been one of the recipients of that, but I don't think it would have been sensible for us to accept it. I don't think the Bundesbank can underwrite exchange rates. That is an open-ended commitment. That turns the provision of liquidity into a potential issue about solvency. And the same is true when it comes to government bond rates in monetary union. The ECB cannot underwrite government borrowing by member countries. That isn't a liquidity backstop. It becomes something which is potentially an issue of solvency. And I know that you can say, well, it's conditional. Well, it's conditional, but if the conditionals create a deep depression, worse than the Great Depression in the 1930s, then something is actually wrong. Now, I think this goes to the heart of a point that Ben made this morning. It is certainly true that Ben Friedman said that whether or not an institution is solvent is endogenous to the provision of the set of actions taken by the central bank. But Ben was very careful not to say that in every crisis, the provision of lender of last resort support ensures that a borrower is solvent. There are situations where borrowers become insolvent, irrespective of the provision of liquidity support. Now, Paul is certainly right that austerity alone is not a solution. The growth rate in some of the periphery countries is too low. But I don't think that outright monetary transactions can be fully credible unless there is a genuine commitment by the governments to say this is desirable and we support it. Lender of last resort is a fiscal action. It's not something that can be left entirely to central banks. There is a very tired and old joke about an economist stranded on a desert island with a can of food, and he says, assume we have a can opener. There are too many economists on both sides of the Atlantic who start by saying, assume Europe's one country, well, then it's obvious what the right policy is. But Europe isn't one country. Now, a lot was made and has been made in general about Mario Draghi's commitment that we'll do whatever it takes. I was present for that too, because that took place in London before the Olympic Games. It was a conference which the UK government put on. It's part of a conference to boost inward investment into Britain. So you might ask why central bank governors from around the world came to this conference. And indeed, having been asked to organise it, I pointed out that I couldn't see any reason why they should. So what will make them come, Mervyn? Well, if you offer them tickets for the Olympic Games, they might come. So I got 4 central bank governors to come to the opening ceremony of the Olympic Games, and they came to the conference on that day. And I chaired it, and Mario Draghi stood up, and I noticed one very striking thing. Mario didn't have a text. This is very unusual for a central bank governor. he had 2 or 3 words written on a small piece of paper. And he made his comment, "We'll do whatever it takes." Now, people assume that statement alone was the thing that changed market sentiment. I don't think that is true, because I was with him for the next 24 hours. What changed market sentiment were the statements the following day by President Hollande and Chancellor Merkel that they totally agreed with what Mario had said and backed him 100%. After all, Mario Draghi had no authority to say, "We'll do whatever it takes." All he could do was to say, "We'll do whatever the ECB is allowed to do." But actually, the trick worked because people believed that governments were prepared to do whatever it takes. Out of that came the promise of OMTs, but ask yourself why it is that OMTs or any other form of transfer have not taken place. Well, we heard the answer this afternoon from Wolfgang Schäuble. There is no agreement on making fiscal transfers between the members of the monetary union. It isn't one country. And that is a terrible issue, which will no easy answer to it, but that is the one that is going to have to be confronted. Now, the last point I want to reflect on is the issues that came up really in that second panel, where I think 2 big questions came out. One was the point that Marvin Goodfriend and Markus Brunnermeier made very clear, which was that time consistency really is at the heart of the issues surrounding central bank policy. They're created in some ways, or their functions now exist in order to overcome a problem of time consistency with government control of monetary issue, and the same is true with the management of provision of lender of last resort support in a financial crisis. The second point is that Marcus made some very interesting comparisons between monetary dominance, fiscal dominance, and financial dominance. And he's surely right that it isn't the question that you have a fiscal theory of the price level or a monetary theory of the price level. What you have is a theory about how does a central bank behave when it's deciding on the monetary issue, and that will determine the expectations of the price level. But the underlying all this is the fundamental point, I think, that our present financial system is undertaking enormous risks in terms of the extent of maturity transformation, and the question is who should bear those risks? Can it be allocated satisfactorily by the private sector, or does it have to be borne by taxpayers, and if so, how? I'm not going to say any more on that, but I think that is the fundamental question about not just the role of central banks, but actually the structure of the financial system itself. Now, before the crisis, central banks really were at the pinnacle of their reputation. The strange thing is, although the reputation has slipped somewhat, central banks have become even more powerful. And I think that one of the issues that will be debated over the next 20 years is whether the degree of independence which central banks acquired in the wake of the great inflation as the method for combating inflation will be still retained if the role of central banks is seen at least as important in other areas where those other areas are essentially fiscal or quasi-fiscal in nature. There is obviously a great deal to be done. I think the panels today have given us much food for thought, and what we now need is to digest those remarks over drinks and a good dinner. And let me conclude on the one practical note that Jens has asked me to tell you about, which is that the bus which will take you to those drinks and dinner at the Schloss Hotel Kronberg will leave immediately after the conference. Please meet in the entrance hall. Thank you.